Hello, everyone, and welcome to Milkshakes Markets and Madness. My name is Brent Johnson, and this is a show where we talk about the financial markets, the craziness and the madness of the world surrounding those markets. And we do that through the lens of the dollar milkshake theory, which is a framework that I came up with several years ago to help me kind of navigate what I believed would be the crazy markets to come. And the reason we focus on the dollar is not because we think you should just be sitting in the dollar, not because we think the dollar is the greatest thing that ever existed in the world. But the reason we focus on the dollar is because it is what underlies the entire global economy. So it's really hard to understand what's going on in the entire global economy if you don't understand what's going on with the dollar. And as such, we have used that as a base layer to focus on the markets as we navigate them. Now, what I thought we would do today is talk a little bit more about the dollar, because the dollar's been in the news a lot recently, and I think it will probably be in the news even more in the weeks and months to come. And so I've titled this, "What is the path to de-dollarization?" What do you need to know in order to understand and kind of think through the headlines when you see them? But before we get to that, I want to reflect on the last week, because last week, I think as many of you know, we had some technological problems as I recorded this episode, hit send, headed to the airport to go see my friend Hugh over in St. Bart's. And on my way to the airport, I realized that only the audio, but not the slides, were recording. So hopefully this week is going a little better. We're able to re-record that episode when we got to St. Bart's. So hopefully you guys all had a chance to check that out. But here's just a few highlights from last week. Now, part of the reason I wanted to go to this is, first of all, Hugh invited me, and he's a nice guy and a friend. And, St. Bart's is not exactly a horrible place to spend a few days in the summer. But really more than that was that back before I ever knew Hugh, I think probably around the 2010 to 2012 timeframe, I came across some of his investment letters. And I started reading them rather religiously, and I started watching his interviews that he would do on TV. And I just loved the way he would think about things. He was always a little bit different than everybody else. He was always willing to say something that nobody else would say. And while I didn't always agree with him, he always made me think. And so when Hugh started doing his summer camp last year and then again this year and invited me, I thought it was a great opportunity. Like I said, not just to have fun for a few days, but really to kind of hang out with other very smart people in a pretty nice setting, hear how they think, find out what they're thinking about. And that this year was no exception. The great thing that came out of this year, I thought, was not so much that somebody had some great stock tip or not something that was necessarily easy to come home and put a trade on, but it was more the thought process that Hugh used to go through when he would make decisions. And so a couple of the sessions that we had when we were actually thinking about markets as opposed to just having fun was people would pitch him ideas, and he would pretend to be the hedge fund manager, and the other people would pretend to be an analyst or a portfolio manager, and pitching him ideas on what they should invest their fund assets in. And I think what really came out for me, and what I think probably also came out of it for many of the other attendees, especially those attendees who were not professional money managers, was how often he would just say no. In other words, you would present what you thought was a fairly good case, and he would say, "No, you need more data," or "No, I want to find out about this," or "No, I want to find out about that," or "No, did you think about how this would happen if this other thing happened?" And, it was really more than anything a lesson in risk management as opposed to just putting on a trade. And so I think, the thing that you all could take away from that is this is not a thing where you read something on Twitter, or you hear somebody say something in a cab, or you read a blog post somewhere, and all of a sudden it sounds like a great idea, and you go and you put 20% of your portfolio on it. The professionals just don't do it that way. And in fact, they try to think through every possible scenario that can go wrong before they even start considering what can go right. And then when they do put the trade on, they typically start off rather small and then build it up over time as the thesis starts to play out. So I thought that was one really good takeaway from the conference. The other thing was not something that I didn't know already, because I've talked about the rise of passive investments, how those rise of passive investments are changing the structure of markets and are changing the dynamics of markets. But there was an attendee there who shall remain nameless, but super, super smart guy. Had done a lot of work on passive investments, very similar to the work that you've heard me talk about my friend Mike Green has done. And really all the things that he had to say really just reinforced my belief that passive investments, for those who aren't familiar with that, that's when you just buy the index of something and there's really no decision making going on. And most of the big asset managers now are basically passive investors. The BlackRocks, the Vanguards, many of the ETFs are now passive, and because there's no thinking going on, and it's literally come down to an algorithm that is as simple as if there's cash in the account, you buy, and if somebody asks for cash, you sell. That has huge implications for the overall markets. And if you want to dig into that in a little bit more detail, like I said, look up Mike Green at Simplify Asset Management. He's done a ton of work on this, and in my opinion, has explained it about as well as anybody. But again, this gentleman that was at the conference, I thought, did a fantastic job of not only building on Mike's work, but really reinforcing some of the thoughts that I had already had about it. So anyway, if anybody ever wants to discuss that in more detail, I'm sure Hugh would love to give you a follow-up, and I'm always happy to answer questions as well. But before I go on any further, I also need to say a very big thank you. And the big thank you is to all of you out there listening, especially the numerous people who have either sent me emails, Twitter DMs, text messages, offering to help me with the show, especially the technology side of the show as we kind of move forward with this new format. Honestly, there's just been way too many people have reached out for me to respond to everybody. But I just want you to know I do appreciate it. If I don't want you to think that I've ignored your messages or I'm not thankful for the messages. I'm incredibly thankful, and I look forward to continuing to do this show. And we're slowly figuring it out. And so don't be surprised if at some point I do reach out to one of you or some of you. But if I don't want you to think that I was ungrateful. But now let's go back a little bit to the markets again. Now, here's a chart of the dollar index going back about 5 years. And what you can really see is that over those 5 years, it hasn't really gone anywhere. It went up in early parts of COVID as a response to the crisis. It then fell in response to the Fed's flooding the market with liquidity. It then rose dramatically as the Fed raised rates in order to combat inflation in 2022. It made a 30-year high almost 2 years ago now, about a year and 9 months ago. And then it has pulled back, and it's largely just traded in a band between 100 and 105 for the last 2 years. The reason it's getting a lot of attention now is because it has started to fall. Year to date, it's flat, maybe down 1%. But now, the Fed signaled a few days ago that it is now time for rate cuts. I think the quote was, "It is now time for policy to change." So while they haven't explicitly stated that rate cuts are coming in September, it was about as big a hint as you could possibly give without actually cutting rates. And as a result, part of the reason the dollar has stayed relatively weak all year is the expectation of rate cuts to come. And now that they have kind of explicitly stated that they're very close, the dollar has pulled back even more. Like I said, it's flat for the year, and it's basically right in the same band that it has been for the last 5 years. And of course, as this happens, now all of the de-dollarization, chatter is back. All of the BRICS currency is going to take over for the dollar is back. All of the dollar is the worst currency ever, and it's going to zero is back. And, as we kind of test this 100 level, psychological level, a couple of weeks ago, I think somebody sent me an email saying, or they sent me a Twitter thing saying this is the dollar's done for now. And my point was, listen, it could be if the dollar goes to 90 or 95, then that kind of signals that everything's okay. If you go back 25 years, every time things are not okay, the dollar is rising. So If the dollar's falling, then that means everything's okay. And, you can be in risk assets. And I think everybody's kind of continues to enjoy their life. But if the dollar starts rising, that's what you have to worry about. And right now, when the sentiment on the dollar is about as low as it's been at any point in the last 5 years, not quite as low as it was in 2021, but pretty close. And we're 20 points higher. I'm sorry, we're 10 points higher than we were in 2021. But sentiment is extremely low. The relative strength is extremely low. The stochastics on the dollar are extremely low. And everybody has kind of given up on it now because they're sure the Fed is going to, flood the system with liquidity. But here's the thing that you have to remember. If they are going to do that, that's not necessarily a bad thing. This shows the year to date. The white line is the dollar. You can kind of see it went up a little bit into April, and since then it's been kind of trending down. All of the other lines are risk assets. But in general, as the dollar comes down, risk assets go up, and vice versa. If the dollar goes up, then risk assets come down. So if the Fed is going to be able to flood the system with liquidity, and if people borrow more money as a result of the Fed lowering rates, and we don't have any blowups in any other parts of the world, and no military problems in the Middle East, and the Japanese yen carry trade doesn't cause any problems, and the real estate crisis in China doesn't cause any problems, then yeah, maybe the dollar goes down and risk assets continue to go higher. However, if that doesn't happen, then we have other things to deal with. And here's the reason why. I think a lot of people in their mind believe that the path to de-dollarization, in other words, if this is it, we are now going to de-dollarize. The world is sick of using the dollar. The Fed's going to inflate it away. Nobody else is going to choose to store their money in dollars or invest in U.S. assets. Then I think a lot of them believe that would mean that the dollar would go lower. But the dollar going lower actually extends the current system. The dollar going lower is what the system needs in order to survive. It's only the dollar going higher that is the path to de-dollarization. And that's what I want people to realize. So if all the dollar bears are right, and the dollar now falls into the 90s and even goes into the 80s, then that means that the system is continuing to function as it was designed to do. Asset prices are rising and everything is fine. It's only through going higher that the system comes under attack. As the dollar goes higher, that puts incredible strain on the system. And if you have any doubt, just go back and look at a 25-year chart of the DXY. Whenever it's going higher, you'll see that there was, or whenever you saw trouble in the world, you will see that the dollar was going higher. And if you just go back to 2022, when markets were falling and the dollar was rising and the rest of the world was in crisis because they didn't know how to respond to a stronger dollar. The system is just not designed for the dollar to continue to get stronger. So I want you to keep this in mind as you're looking at headlines in the days or months ahead. Because right now, I think everybody's expecting the dollar to fall off the cliff. And if it does, then I think, like I said, I think the world is fine. But I think the world is in a much more dire position than a lot of people think, or at least it has the potential to become dire very quickly. Right now, it's not, but it has the potential to do that. And I think when that happens, you will see the dollar rise rather than fall. But part of the reason, and this is important to understand, because a lot of people will talk about the money supply. The Fed is going to include the money or increase the money supply, or they'll say M2 is going to start to rise, and therefore that is going to cause the dollar to go down. And they'll focus on the supply of money. But what you have to remember in a debt-based monetary system, which we have, where money is loaned into existence, the money supply is mostly also money demand. And so I just use this as an example here. Right now, the monetary base, I'm using a monetary base of 4 trillion in this example. In the real world, it's around $5.5 trillion. And then this is what they do is they use that monetary base to loan more money into existence. That's the non-base supply. So let's say that's another 12 trillion. So that would be M2 of 16 trillion. Now, again, in real life, the monetary base is around 5 trillion, M2 is around 20 trillion. But this works for the example. But what you have to remember is that the 4 trillion at the bottom, the base money, that's the only money that actually exists. That's the reserves that are at the Fed, as well as the currency and coins in circulation. All of the money that's been loaned into existence, all the money in blue, it's just ones and zeros in a computer screen. It's levered money that doesn't actually, it's almost like a game of musical chairs. The 4 trillion chairs at the bottom are chairs that exactly exist. The problem is there's 16 trillion in chairs, or 12 trillion in this example, circulating around that 4 trillion. And all of that 16 trillion is a claim on the 4 trillion. And so again, if the music stops and everybody has to scramble for the money, there's just not enough money to go around, and the value of each of the chairs goes up in value. So that's what you have to remember. In a debt-based monetary system, the money supply is actually money demand. Now, I'm going to show you this chart. Now, this chart's actually about 5 or 6 years old. I apologize, I didn't get a chance to update it before I jumped on this podcast here. But this basically shows different levels of claims on the monetary base. Now, in this example, the monetary base is this blue line down here. So let's call that 5 trillion. M2, again, is about, in this chart, it's about 16 or 17. Again, that M2 is a claim on the monetary base. The yellow line, that's the federal debt. Now, at this time, it was around 26 or something. We all know now it's closer to 35. But that, too, is a claim on the monetary base. And then the pink line, this is all securities, debt securities and loans, right? Those are ultimately a claim on the monetary base, because you have to get money to pay back these loans. When money is loaned into existence, those loans are future demand for money. But again, the only money that actually exists is the monetary base. Everything else is just a claim. And so that is why when you see, when you see something that's cost about the money supply, you have to understand that most of it is also money demand. Now, this is why this is also important. I sent this tweet out, I don't know, a year or so ago, and I went back and I just clipped it to put it here. And the point is what you have to understand about de-dollarization is that de-dollarization is the same thing as deleveraging, because most of the dollars in the world have been loaned into existence. So if people are going to stop using dollars all over the world, then they first have to satisfy all those loans. So they have to deleverage. So you can't de-dollarize without deleveraging. But deleveraging implies deflation, right? And the system cannot survive deflation. When you have a debt-based monetary system, it has to grow, because if somebody doesn't get paid, then they can't pay the person that they owe, and that person can't pay the person that they owe. And you get a reverse daisy chain where everything kind of collapses back onto the monetary base. And that is why when you get a bank run, everything collapses really quickly, because there just isn't money to go around. And this is really just when we get these scares and the dollar gaps higher, such as 87 or 2000 or 2008 or 2020, that is the system deleveraging very quickly. And again, because everybody's scrambling for the few dollars that actually exist. And so that is why when a debt-based system deflates, everybody's scrambling for the chairs. And that means the chairs go up in value. In our world today, everything runs on the US dollar. So if you're going to have deflation, that means the dollar is the underlying collateral. That means the value of the dollar rises as the system deflates. So you can't have the underlying collateral of the system be US dollars and falling. If the dollar is falling, then there's plenty of liquidity. Again, a deleveraging happens when there's not enough liquidity. If there's enough liquidity, then the dollar doesn't need to rise, right? And the dollar can fall. But if the dollar's falling, then again, there's plenty of liquidity. There's no crisis. So this basically just goes back to why you can't de-dollarize without first deleveraging. And a deleveraging event causes the underlying collateral to rise. The underlying collateral happens to be US dollars. So again, keep this in mind when you see these headlines about the dollar is now done, it's going to fall. And again, I'm not saying the dollar can't fall. The dollar can absolutely fall, but the dollar falling doesn't lead to a global crisis. It's only and it doesn't lead to the system changing. It's only the dollar going higher that throws a wrench into all the system. And again, this is another way to think about it. I think people have seen this before. This is called Exter's Pyramid. And it basically just shows that gold sits at the very bottom of the pyramid, which I've always agreed with. But above that sits paper money. And the paper money that underlies the entire system is dollars. And so if you think that all of the money in the world is going to get out of risk assets and flow into gold, I don't necessarily disagree with you, but you have to go through the dollar to get there. So if you're bullish on gold based on a deleveraging event, and you're bullish on gold because you think all of these claims are eventually going to find their way into bullion, they first have to travel through the dollar to get there. So if you like this chart because you're a gold bull, then it's hard not to like this chart, or it's hard to not be a dollar bull if you use this chart as well. So let's see, what else can we talk about here? Part of the reason that I think that I'm bringing this up now is because, again, sentiment is just way down on the dollar. The relative strength is way down. The stochastics on the chart are way down. And now everybody's given up on it. And that's about the time that you get a reversal. And so, and the other thing that's coming up in the next couple of weeks is their annual BRICS meeting. And of course, in the last couple of weeks, there's been all these tweets and headlines going around. Oh, this is it. The BRICS are now going to adopt this new payment mechanism, and they're going to stop using the dollar. So again, keep all this in mind as you read these headlines. If the world is going to leave the dollar and go to the BRICS, the world first has to deal with all of their U.S. dollar debt. And the U.S. dollar debt, there's more U.S. dollar debt owed outside the United States than there is inside the United States. And so how they're going to have to deal with that before they move on to something else is of utmost concern. This is just another way to look at the monetary base. The pink line here is the monetary base. Now, this is the legend for this is on the left, and it shows the monetary base. This is just the reserves. This is just the reserves. So this doesn't include the currency in circulation. And its legend is on the left, and it's in millions. So it's about $3.5 trillion. The black line here is bank credit, all the money that's been loaned into existence. Now, the reason I'm showing this is because typically when you get into a crisis, the Fed will flood the market with reserves, increase the reserves, and that is usually, the result of easy monetary policy. So because we're now approaching rate cuts, I think a lot of people thinking that it's only a matter of time before we go back to QE. And they think that QE is what then leads to high levels of inflation. That's only the case if banks then loan money into existence based on the level of reserves. But the point I want to make here is reserves only, my friend George Gammon made this point, I don't know, maybe 6 months ago. And when he said it, I thought it was perfect. But reserves only really matter in that they signal a level of intention from the monetary powers. And what I mean by that is this chart only goes back to the 1990s, but I could take it back another 30 or 40 years and it'd show the same thing. That reserves stayed relatively low for a very, very long time. And this black line was the loans that were being created off of the reserves. The reserves are used for collateral to make loans. And you can see for decades, all the money that was loaned into existence kept rising. The bank credit kept rising, even though reserves didn't rise. Now here you started to see bank credit start to roll over in kind of the 2008 timeframe. And that is the global financial crisis. And that is why they then flooded the market with reserves. They flooded the market with reserves in order to signal that they would do anything it took to get this under control. And then the banks slowly started lending again. And you can see, really from 2009 until 2013, lending didn't really do that much. And then in 2013 or 14, when reserves were raised again, then that kind of started the current melt up in reserves or bank lending. But now you can see again, bank lending in shortly or maybe in the last couple of years started to roll over a little bit, and now it's kind of picked up a little bit. But the Fed thinks that the economy is slowing enough now, and so they're going to raise rates. But the point here is that when the Fed floods the market with reserves, it can lead to an increase in the money supply if the banks use those reserves to then increase the money supply. But if they don't use the reserves to increase the money supply, it isn't inflationary, and they wouldn't even need more reserves to increase the money supply if they wanted to. What it really comes down to is whether or not the banks want to take the risk of making new loans. And so as we think about that, as we're now going into a place where the Fed is going to cut rates because the market is starting to slow, does that indicate to you that if the market is starting to slow, that the banks are going to want to loan more? They're going to increase their loans during a risky environment? So that's something to think about too as we go through this. Now, the reason I bring that up is because I think a lot of people are very excited that the Fed is now going to cut rates. And, the stock market liked it when Powell said that yesterday. And even though we had a very hard sell-off last 2 weeks of July and into the first week of August, those have mostly all been reversed now. We're back within a 1 or 2% of the highs. And now we got Fed cuts coming, and people are excited because that should send the market higher, right? Well, if you look at this chart, you can see historically, now this goes back to the 1990s. Again, when the Fed cut rates in 1990, that led to the market correcting. When the Fed cut rates in 1995, when the Fed cut rates in 1990, it didn't really affect it. So there we're kind of 1 out of 2. When they cut rates in 95, it did lead to a pullback. When they cut rates in 2000, it led to a pullback. When they cut rates in 2008, it led to a pullback. When they cut rates in 2020, it led to a pullback. And so here we are again. But the point of this chart is that typically what happens when the Fed starts to cut, that's when markets typically either continue selling off or start to sell off. And the reason is because the reason the Fed is cutting is because things are not improving and are actually starting to get worse. And so I think all of the people who believe that the Fed cutting is going to be a boom for risk assets are going to be in for a surprise. Now, what I actually think is going to happen, and we'll have to wait and see, but what I actually think is going to happen is I think the market is going to kind of wake up over the next couple of days, sometime in the next week to 10 days, and it's going to roll over hard the same way it did in late July. And I think the reason it's going to do that is the realization that if the Fed is going to be cutting, that's not necessarily a good thing. And that the valuations on everything is not that these companies are bad, but the valuations have just gotten way ahead of themselves if we are in an economy that is slowing. And so what I think is very possible, we will get a very hard sell-off over the next couple of weeks leading into the Fed meeting. I think it's September 18th. I think that they will cut. I think they will probably cut 50 basis points rather than 25. I think they'll probably cut 50. And I think the negative market action leading into that will give them the cover to do that. I think when they cut 50, the markets will maybe for a couple of days or a couple of weeks bounce in reaction to that cut, but I don't think it will last very long. And then I think we will see a further sell-off, and that further sell-off, I think, we'll have to wait and see, is going to be a pretty decent buying opportunity either in late September or sometime in Q4. We'll have to wait and see whether that's the case, but that's kind of my base case for right now. Let's see, what else did I want to show you? I think that was it for this week. I just kind of wanted to give everybody an update of kind of where we're at, the things I'm thinking about, give you an update on how summer camp went, and look forward to catching up with everybody again next week. So I hope everybody's having a nice weekend. Good luck trading the markets. If you are long risk assets without any funds on the side, without any kind of protection, without any kind of hedges, I would recommend that you start thinking about doing that while market prices are high and the VIX is back low again. I will certainly be looking this week to probably add to the hedges that we already have. Okay, that's it for now. Look forward to talking to you again next week and hope you all do well.